Hey everyone, I would like to address the topic of a carry trade. As I'm recording this here, over the past few weeks, we've seen quite a bit of turbulence in one of the most popular carry trades. In fact, it's the biggest one at the time I'm recording this that we've ever seen, which is in dollar yen. And so I'd like to expand a little bit about what a carry trade actually is and why it's so important to understand this as an investor in pretty much most liquid assets like fixed income, certainly equities and ETFs, and certainly if one is using derivatives on those as well. So let's start with a very basic definition of what a carry trade is. And really, when we're looking at a carry trade, we are looking at an opportunity that a typically more sophisticated investor tends to be either a hedge fund or a family office or a very high net worth individual that's doing this in conjunction with their private bank or investment bank is doing. And so basically what it is it's a borrowing of cheaper funds that then can be invested at a higher interest rate or for higher returns somewhere else. And the biggest trade or carry trade that has ever existed, at least so far, as I'm recording this, has been in the yen. And so what these investors do is they borrow yen, largely because they've had for a long period of time very low, in fact, more or less zero interest rate. And so when they borrow that sort of basically almost free money, they can then go ahead and invest that somewhere else. And so in theory, this is a very low risk trade, but like everything or most things, there's really no free lunch, particularly if things move swiftly. And in the case of the dollar yen carry trade, which we've seen, the yen starts to strengthen. So I've prepared a very simple example that I think should really help people understand this. And once we've gone through this example of a carry trade, we can then spend a little bit more time also on talking about how this affects markets and how this might affect someone's portfolio. So I made some notes here. Let's assume that I want to go out and borrow 1 million Japanese yen. So I will call my private or investment bank, and they will work with their Tokyo desk or however they're structured, and they will look to see that I can borrow 1 million yen. The reason why I would do that is because I found that in Japan, again, it's basically free, or at the time when I would do this trade, zero interest rate to borrow these yen. And I would want to do that because when I borrow these, I then want to swap those yen into dollars, i.e. buy dollars with those, and then invest it in a higher interest rate. So as I'm recording this, here in the US, we have about 4% rates, or a bit higher. Or I can certainly buy things with it, like equities, which is what a lot of funds have done and continue to do. So if I have an exchange rate of 140 Japanese yen to $1, so if I have $1 and I want to buy yen, I get 140 yen in this example. Then if I were to receive 1 million yen, it would cost me, quote unquote, only 7,143 US dollars. So that's just taking 1 million yen divided by the 140 exchange rate. And I can then go ahead and invest. Once I swap those yen into dollars, I can go ahead and invest that into interest rates for basically no risk on the interest rate side, or with, let's say, stocks. But let's assume the yen starts to appreciate in value, which is exactly actually what has happened recently in this carry trade, is starting to become a problem for some investors. So let's assume that all of a sudden it no longer is 140 yen per dollar, but only 120 yen per dollar. So in order for me to buy to receive yen, $1 only gets me 120 yen. So now that I've received $7,143 and I multiply that by the new exchange rate, which is 120 yen, so times 120, I now only have 857,160 yen. In other words, I borrowed 1,000,000 yen, so I owe someone, whoever that is, investment bank, private bank, whatever, 1,000,000 yen. But because the exchange rate changed, I now only have 857,160 yen. So that's a problem, because at the end of the day, I now lost money, not even on my investments that I made in dollars, but just on the exchange rate that is supposed to be kind of the basis for my quote unquote free trade. So what that leads to in turn is a balance sheet problem for me. So what typically happens is I would get a margin call. If you've ever had a margin call, you know it's typically no fun. And basically the other side of my trade, so the bank that allowed me to borrow the yen, is going to force me to make up money so I can still cover that 1,000,000 yen obligation. So depending on the severity of the problem, typically I can either go and borrow more yen. That would be one thing, but that would almost kind of be like doubling down on the bet. Or because I have a margin call, I'm gonna have to start selling assets that I bought with dollars, which originally came from those borrowed yen. So let's assume I borrowed those yen, swapped them into dollars, and then bought, the Max 7 stocks, the Nvidias, the Apples, whatever. That's a problem, because now I'm gonna have to start selling those stocks just so I can then come up with money to meet that margin call. And so, as you can see, this leads to a problem, and where it really becomes an issue is with sort of market structure. Because while a lot of people analyze the fundamentals of a company or the economic data, these what I call structural analysis, it's really part of like flow analysis, fund flow analysis, can cause major problems. And it's actually very difficult to measure how big this carry trade is at any given point. There's data from various exchanges and so on and so forth, or you can talk to the big broker dealers to the extent they're willing to be honest about what they're seeing in terms of how big that trade might be. But currently, as I'm recording this trade could be, my estimation from what I'm looking at here, and I'm I certainly don't have more information than an investment bank, but I think there's a good chance that it's actually quite a bit larger than some people care to admit. And so what it can lead to is sort of a fairly persistent, selling activity on the part of these funds that borrowed yen that are in this carry trade. And so that selling continue for quite a bit. So at some point, of course, it's over, and then that part of the equation starts no longer be relevant. That's a carry trade. That's specifically the dollar yen carry trade. Thanks for listening, and I hope this was helpful.